So many traders are constantly looking for the next best trading strategy, but that is one of the worst things that you can do. In this video, I'm going to be running through a couple different simulations to demonstrate why even if you have an amazing trading strategy, there's still a really good chance that you will lose your entire account. And we're going to start off with an example from none other than Wall Street Bets. And this is actually a pretty crazy and sad example. And we can see how this user made a post on Wall Street Bets about 3 days ago showing how he took his account from $200,000 to $9,000. He lost all of the money his grandma gave him before she died. And this is a very sad and unfortunate example, but there are some crucial things that the rest of us can learn from this. And that, just by looking at the portfolio change over time without even looking at the stocks he traded or the positions he took, there were some crucial mistakes made, and that was the portfolio's volatility. We can see at some point, he was doing very well. We can see that, the portfolio started right where my cursor is, and, for some time it was growing in a pretty awesome way. But the concern was the level of volatility in this portfolio. We can see just by looking at my cursor, the portfolio would go from this low point all the way up to this high, and then all the way back down to the low, and then back up high. It was just it was all over the place. And that volatility alone is what destroys so many retail traders' accounts. So if we look at a quick simulation that I made on Google Sheets, let's say you had a starting portfolio of $5,000. Whether you use this simulation for $5,000, $2,000, $30,000, or $500,000, the dollar amount doesn't matter. The main point is what matters, which is what I'm going to demonstrate in a minute. Let's say with this simulation, we are assuming a 50% win rate and a 50% loss rate. And then when you win, you increase your portfolio's value by 50%. And when you lose, you decrease your portfolio's value by 50%. A lot of people will initially see, will hear those numbers and say, you know what, that's not too bad. I don't expect the portfolio to do too bad over the long term. It's just it's a 50% chance. But that's not the case. Basically what happens when you have those insane levels of volatility, it's not a matter of if your portfolio will blow up, it's a matter of when it will blow up. So basically, if we look at this simulation, it starts off at $5,000, the portfolio or the simulation has a couple nice months where the portfolio's value increases all the way up to $36,000. But then it goes on a losing streak and it takes its value from $36,000 all the way down to $15. And the reason because of this is because of the volatility within the portfolio. When you have giant swings where your portfolio is increasing by 50% or decreasing by 50% in a day, week, month, or whatever, it's just a matter of time when your portfolio blows up. So decreasing that volatility is a giant thing. And the main reason I bring this up is because I see so many retail traders, post on Wall Street Bets or screenshots on social media or whatever saying, oh, look, my portfolio increased by 48% today. And while that's awesome, it's also very scary at the same time, because if your portfolio is increasing by 48% in one day, what do your losses look like? And that's a giant concern. Because like I said, when you have those giant swings from an increase of 50% or a decrease of 50%, it's just a matter of time before you lose everything, just like in this example. We can see it went from 5,000 up to 36,000 over the course of a couple time periods. But then it ended up losing it all because of that volatility. And even if we change the simulation that favors retail or favors this hypothetical account even more. Let's say you're still going to win 50% of the time and you're still going to lose 50% of the time. When you lose, you'll lose 50% of your value. But let's say when you win, you increase your account value by 65%. We can see still it doesn't work. When you have those giant swings, it just doesn't work. Like another example, went from $5,000 all the way up to, highs of $23,000. Yeah, $23,000, and then lost it all basically. We can just cycle through countless examples and they all basically look the same. Example after example after example. Yeah, you might have these awesome swings where things are going great for a little bit, but it's just a matter of time before you lose it all. And the scary part is that this simulation is not even accounting for trading costs like commissions or other fees. And if you say, oh, Robinhood doesn't charge commissions, they still charge you to trade. It's just not in the form of commissions. It's through the form of bad fills. So for example, let's say an option's real value should be at like $100, and let's say the bid is at 95 and the ask is at 105, you'll probably have to pay 103 or 104 or maybe even 105. So it's like, yeah, while you're not being charged commissions, you're still getting screwed over on the back end because your data is sent to like different institutions and different firms like Citadel who are routing your orders and profiting that way. So it's like Robinhood still makes a ton of money. It's just not through the form of commissions. It's just all made on the back end. So it's like you're still paying the commissions in a way. But anyways, that's a topic for another video. The main point is that portfolio volatility destroys accounts. In this video, I'm going to show you one way to decrease volatility, or at least, that's what we're trying to do. So if we go to another example I built, let's say instead of having these giant swings of 65% or 50% or even 30% and 30%, let's say we took it down to nice, slow and steady, consistent returns. And I know this example is a little bit oversimplified, but we're going to use it anyways to demonstrate the point. So let's say you have a portfolio that starts off at $5,000, and let's say you can just get like a monthly return on average of 2%. Like so many retail traders here, 2% over a month, I don't want anything to do with that. 2%, that's it. If you can get a 2% monthly return every single month for, let's say, 4 years, you will take a $5,000 portfolio to almost $13,000. And that's if you start off with $5,000. If you were to start off with, let's say, $10,000, 10,000, all right, 10,000, 2% a month every single month for 4 years, you would take your portfolio from $10,000 up to $25,000. So it's like, stop shooting for home runs. Like when you're like really trying to crank a home run every time, your portfolio will look like this. Sometimes you will do very, very well, but it's just a matter of time before you strike out, and it's going to hurt. It's going to hurt bad, just like we see in these simulations. So instead, if you consistently go for those singles and build your portfolio over time, it will be, one, much less stressful, but it'll also be more profitable. And it's also a lot more scalable, obviously, because you're not blowing your account. But anyways, so, this just demonstrates that the singles add up, right? And, 2% a month can be a little bit difficult. So let's say you could even get 1% a month. Like, it's still consistent growth, and it will I can almost guarantee you that a consistent type of portfolio like this will outperform any whack portfolio like this. Like sometimes you get lucky, but most of the time it just ends in destruction just like that. But anyways, let's say you're someone who's very talented, or let's say you short some at the money puts, or you buy some stocks at amazing levels. And let's say you can average a monthly return of 5%. If you start off with $10,000 and you can average a monthly return of 5% over the course of 4 years, you will have $104,000. And like I said, 5% is pretty hard to do. So like even if we, kept it at 2%, it's the point that still applies. And what's really cool is your monthly income will grow over time as well. So in the same way that your portfolio compounds in value, so will your monthly income. For example, like I said, if you could get a 2% return every month for 4 years, your monthly income will start off at $200, but by the end of that 4 years, it'll rise to $507. So you're probably wondering, all right, Mike, maybe I want to try this safer sort of approach. I love selling put options. That does not mean you have to. There's a lot of ways you can try and squeak out a 2% return every month. I prefer to sell puts because there's an edge there, and you literally get paid to buy stocks at a low price, but that does not mean you have to do that. But there are so many times where, like, I emphasize the importance in the consistency of selling put options. Like let's say with Corsair, like let's say I'm like, all right, I like the 20 strike puts for Corsair April 14th, 2022 expiration, and like this would be a short put. So like right now you would get around $70 if you shorted that put option. It's a 20 strike price. So long story short, you have to put up $2,000 and you'd make around $70 back. Right? And then, if the stock fell below 20 on the expiration date, you'd have to buy the stock, but let's say it expired worthless. The main thing is you're getting paid $70 and you're putting up $2,000, and it'll take around 26 days for this trade to fulfill, you can say. And a lot of retail traders would kind of like, I don't know, they'd be like, Mike, there's no way I'm going to put $2,000 down to get $70 back. And they'd be like, I am not getting a 3.5% return. Like, that's terrible. Why would I do that? But it's like, if you can do that every single month consistently, that will consistently grow your account, and you will likely outperform the market and basically any other trading strategy. So it's like, I get chirped a lot for like, mentioning short put options, because it's like, oh, I'm not going to get paid. I don't want $70 for 2,000. That's what I hear all the time. But it's like, it grows, it compounds, and it's very important. So I hope you guys learned something from this video. The main takeaways is that, sure, you can go for home runs, and they might work in the short term, but unfortunately, extreme levels of volatility within your portfolio normally end up in situations like these on Wall Street Bets. And it's very sad, but the main point of this video was to kind of shed some light on the importance of portfolio volatility, because I feel like everyone's always talking about the next best trading strategy or this or that or whatever. But like, I feel like it's important for retail traders to truly understand why volatility is so important. So, I really hope you guys learned something from this video. The main point of it was to, help as many retail traders as possible learn the importance of portfolio volatility. If you learned something from this video, please subscribe if you're new, but comments really help a lot too. So it's like, if you guys leave a comment, I would greatly appreciate it. If you're new here, please consider subscribing. And then actually, last but not least, the topic of singles over time is very important. Just like in this simulation that I highlighted here. We can see, with the $10,000 starting amount, if you can average 3.5% a month, or 2% a month, or even 1% a month, that is a game changer over the long term. And if you're looking to see how I like to structure this type of setup within my own portfolio, check out that first link in the description and the comments down below. Every single day, we have multiple posts highlighting different opportunities for setups just like these, where it's like, all right, you're not going to get a 80% return on this trade, but you have a very high probability of getting, let's say a 3% return or a 5% return. And we post setups like this every single day. So if you trade stocks or options, definitely check out that first link in the description and the comments down below. We have a bunch of different setups posted every single day just like that give you the opportunity to compound your account over time. For those of you who are in the stat modeling program already, it's the premium selling channel. We post multiple posts per day highlighting opportunities that aim to make your portfolio like this. So again, thank you guys so much for watching, and check out that first link in the description and the comments down below. You can cancel at any time, and we have a coupon running.